Good afternoon, everyone. Hi, and welcome to the analyst meet for Bank of Baroda's financial results for the quarter ended June 30th, 2023.
Recording in progress.
Thank you all for joining us. We have with us today Mr. Devdutt Chand, the Managing Director and CEO of Bank of Baroda, and he is joined by the bank's executive directors and the Chief Financial Officer. We will start with a short presentation followed by opening remarks by Mr. Chand, followed by the Q&A session. Over to you, Chand.
Good evening all. I am D. Chand. I am the MD and CEO of Bank of Baroda. To introduce you to the management team, we have Mr. Ajay K. Khurana. He is the Executive Director looking after the recovery vertical and also the MSME and Agri along with other platform functions. So we have with us Mr. Jaideep Dattaroy. He is the Executive Director. He looks after the digital and also the retail asset and retail liability. We have Mr. Lalit Tyagi. He is the Executive Director. He looks after the corporate credit, the international banking, the treasury and the HR function. We have Mr. Ian D'Souza, the CFO of the bank, to whom I believe that you know him from last many quarters now. So with this, I request Ian to run through the presentation. Thereafter, I will have my opening address and then we'll go for the question answer.
Thank you, sir. Good evening, everyone. So we start with the headline numbers in terms of business growth. In terms of advances, we had a strong growth in global advances of 18%. So this was largely broken down into domestic advances growing by close to 17%. International has grown 23%. There is some element of exchange movement there that resulted in a little frothier growth than would have been reported otherwise. In terms of retail, we have retail growing 25%, leading the growth in advances across the board. Agri has been growing at 15%, MSME at close to 13%, corporate advances growing strongly at close to 15%. Within retail, we've had the entire secured book growing strongly, home loans at 18.5%, mortgage growing 16%, education growing 21%, and auto loan growing 23%. While personal loan has been a small base for us, that too has grown very strongly, but continues to be a little more than 2% of the overall book size. In terms of total deposits grew at 16%, led by international and domestic, which is the bulk of our deposits, growing at close to 16%. As has been a secular trend across the industry, CASA has been growing at a little lower rate, and we'll talk more about it as we get into our discussion as to what we plan to do on our CASA growth. Term deposits grew around 24%. In terms of domestic CD ratio, we have adequate headroom, and you would see our CD ratio gradually inching up over the last few quarters. Our global CD ratio is at 84%. In terms of yield of advances, year on year, our yield of advances has gone up smartly. But in terms of the exit yield on advances, if we normalize that for the more than expected recoveries that we had in Q4, you would actually see a 10 basis points increase in yield on advances. In terms of cost of deposits, as has been the sector, that has been inching up over the last few quarters. And this quarter, the cost of deposits at 4.7 almost. Our exit NIM at the end of FY2023 was around 3.53. If we normalize this for the strong recoveries I spoke about in Q4 of last year, that would be a normalized NIM of 3.41. Against the normalized yield of 3.41, we've seen some compression of around 14 basis points to end this quarter at around 3.27, slightly below the full year NIM of 3.31. In terms of NII, we've grown strongly at almost 25% year on year, quarter ago. And in terms of operating profit, it's up by 73% over the last year. Profit before tax is 106% up, and profit after tax is almost 88% up. In terms of GNPA, that has been steadily coming down, and it is almost halved to end the quarter at 3.51. And NPA, we're happy to report, is below 0.8 at 0.78. We've strengthened our PCR, and our PCR, including TW advances, is now at 93.23%. Our slippage has been coming down quarter on quarter and is now at 1.05 against a slippage of 1.71 a year ago. In terms of credit cost, our reported credit cost is 70 bips, and it's on account of the fact that we took a floating provision of 200 crores in the June quarter, as well as we made certain provisions, account-specific provisions of around 420 crores to strengthen our PCR. Combined together, if you adjust for that, the credit cost on a normal basis would be 0.44 basis points. In terms of SMA 1 and 2 for acrylic loans above 5 crores, we've seen that ratio coming down steadily. It was more than 2.5% about a year, more than a year ago, but consistently we've been reporting it below 50 basis points. This quarter as well, adjusted for one large aviation account, which we spoke about last quarter and which we have prudentially provided for, adjusted for that, which is in SMA 2, we would be just at 0.29 SMA 1 and 2 above 5 crores. In terms of collection efficiency, we've seen that strengthening quarter on quarter and maintaining a level of around 98%. This quarter, there was just one account which got collected after the quarter end. And if that account had been collected on the last day of the quarter as was scheduled, we would have reported a collection efficiency of above 98 and 98.86. In terms of CET, the bank continues to be strongly capitalized, and this quarter we reported a CET1 ratio of 11.94. If we had added back the profits of the quarter, we would have been at 12.39. At a CET1 higher than the exit CET1 of FY23. This is despite the fact that our RWAs grew by almost 20,000 crores. Similarly, overall CRAR, while reported at 15.84, if the profits had been added back, CRAR would have been 16.3, a tad above our exit March 2023 CRAR. With that, I come to the end of my presentation and hand it back to Firoza, the moderator.
Thanks, Ian. Shansa, will you make opening remarks, please?
Yeah. So once again, all ladies and gentlemen, good evening to all of you. And again, we are thankful to all of you for sparing your Saturday afternoon for us. Let me have my opening remarks on the presentation was run through by Ian. Normally, the June quarter is considered as a moderate quarter, but as a bank, I'm quite delighted that we have shared a very strong all-round performance for the bank that has focused on the profitability and also some aspect of the balance sheet strengthening. We maintain our journey towards the asset quality. That is a very core as far as the bank is concerned. We are also reinforcing our commitment towards excellence and sustainable growth. If I have a credit outlook, the quarter has seen a strong quarter-to-quarter growth of 2.2%. And normally, in many quarters of June quarters, you would have seen last earlier years, there is a sequential decline normally happens. But then this is one of the strong June quarter, wherein our loan book has gone up by 2.2% quarter to quarter, and also on 18% YOY, which is a very strong growth. At the same time, the retail growth has been 3.4% quarter to quarter, and the full year is 24.8%, highlighting our emphasis on the retail loan book growth as a portfolio mix. We continue to have the same guidance that of last quarter to grow above the industry by 1 to 2%. And on the retail side, we wish to grow almost 4 to 5% above the industry average. The full year FY24 estimate would be, we expect the loan growth to be in the range of 14 to 15%. The corporate growth would be 12 to 13%. The retail growth would be 18 to 20% and can be higher also. whereas the international, which is one of the strong growth we have seen in the earlier year, would grow in line with the book growth that is at 15%. The strategy, as I said, will continue to pursue our retail strategy to grow significantly on the retail side of the book. And in a couple of years from now, we look for a corporate share of 35% and non-corporate would be as high as 65%. Pursuing the same growth in all segment of 15% on the corporate and slightly higher in the non-corporate segment. On the NIM side, the last year full year NIM was 3.31%. That is, if you compare the last full year NIM, there is a marginal dip in the quarter ending June. And this is obvious because of the trend that we have seen in the market also. Bit of cost push in terms of deposit has come up to the books and that has resulted a marginal dip. But if I compare the NIM of that of last June quarter of last financial year, there is a significant improvement therein. So we keep our guidance of putting a NIM of 3.3% for the FY24 estimate also. On the cost to income, although we have not given any guidance, but again as a bank, as a strategy, we tend to pursue a lower cost to income ratio. We have seen some traction in this quarter itself on the cost to income and pursue the lower trending of cost to income in the consequent quarter also. On the corporate side, we have introduced the concept of share of wallet and relationship management. And we have created relationship vertical for the corporate and we are again getting the same relationship management vertical and account planning concept to mid corporate and MSME customer also. One important strategic initiative that we have taken this year as a year of fees and flows, that is F and F. What exactly I mean by fees and flows? The fees talks about channelizing the bank entire resources to augment the fee side of the book. At the same time, flows talks about capturing the flows of each customer, whether it is a retail customer or corporate customer. One of the tool to capture that I do have a very strong CMS tool. We have onboarded large number of customers this financial year and also last year, and we'll be aggressively pursuing for more and more CMS onboarding of customer. At the same time, the retail customer who are transacting with us will try to capture the more flows of those retail customers. The idea is to have more cash flows in the system so that I can customize product to the requirement of the customer. The profitability has been very strong. As I said that the 88% jump in the YOY growth for the June quarter is a substantial growth that we see. At the same time, we continue to maintain our guidance of 1% ROA going forward. Another important thing I am happy to announce that if you compare the last full year profit of 14,110, the first quarter profit is almost 30% of the last full year profit. Asset quality is one of the important aspect of it. And as we said that we also making efforts to strengthen the balance sheet further. The PCR is at all-time high of almost above 93%. The GNPA improved by 275 BPS YOY. The net NPA is now less than 0.8%. As I said, as we said earlier, saying that we had uniquely created the collection vertical. And because of the efforts in terms of close monitoring and collection, on the asset quality, the trending is positive. And the net slippage we have talked about in terms of fresh slippage and also the cash recovery plus upgradation, it would be very less or negligible in that respect. Deposit is one of the core area for this financial year as far as the bank is concerned. This is the same trend that we see in across the industry. The CASA growth has not been very strong for most of the banks, and that is obviously because of the rate cycle we are in. But having taken note of the lower CASA growth, there will be a lot of focus would be on the CASA growth going forward. We have taken a lot of initiative in terms of extending our franchisee, strengthening the relationship management on CASA, so that at least we wish to grow higher than the growth that we have achieved for this quarter. With this, I close my initial comment and then I open the forum for question and answer. Thank you.
Since there are no questions at the moment, we'll wait for 30 seconds for the lineup to populate. Thank you. The first question is from Nitin Agarwal. Please unmute yourself and ask the question.
Yeah, hi. Good evening, everyone, and congrats on a good quarter, sir. So first question is on the margins. You are suggesting that NIMs will remain stable here on at 3.3 for the year. So are we not looking at any further compression at all, say in the second quarter? Has the cost of deposits peaked out? And therefore, what is the extent of asset repricing and the deposit repricing that you are looking at when you make that guidance?
Thanks, Nitin, for asking this question. When we say the guidance of 3.3 for the full year, it's for the full year, point one. Secondly, the cost of deposit, the impact would be there in this financial year, but there are two positive upside we have in the book. One is with regard to the resetting of the MCLR book. All the book has not reset as on today because there is a 1 year resetting time period. So there is a bit of upside available there. And that typically compensates part of the cost matrix, cost push, the impact of the cost push on the deposit side. Secondly, if you look at because earlier also we articulated that we typically try to have a high cost deposit on a lower tenor. So thinking through a scenario wherein there is a rate cycle reversal happening, maybe something Q3 or Q4, will be one of the bank taking advantage of the repricing because of that. So to sum it up the entire thing, and if you look at my international book, the NIM is rather increasing in that way because you have seen the global market, how it is behaving. And we do have a 15% significant international book in the entire book. So considering all the factors, we are still hopeful to maintain the 3.3% NIM margin. But any update further, we'll let you know in subsequent quarters, but we are quite hopeful that we'll maintain the 3.3% NIM for the financial year FY24.
Right, sir. So related to it, the other question is on the yields. Now, this quarter, the yield improvement has been very calibrated, and I believe MCLR linked loans would have got repriced this quarter also. And but probably the improvement is looking small because of the one-off recoveries that you had in the fourth quarter. So how much benefit did you really get, and are you able to pass on the MCLR linked rates to the borrowers?
I think MCLR linked it is like the entire resetting. See, there is a lag in terms of the book in terms of MCLR and BRLR, right? BRLR is the external repo linked portfolio. But at some point of time, both would converge, right? That is what the lag effect of that. So in terms of passing on the MCLR impact, we are able to pass on the impact to the customers, and that is how the market is at this point of time. But Jan, anything further you want to supplement on this question?
Yes, sir. So in terms of if you normalize the Q4 yield on advances, then we actually see a 10 basis points of sequential quarter increase in yield on advances. I just wanted to add that point to give you a context.
Okay. So if you could just quantify the restructured assets, the number as to how much it is outstanding.
Yeah, I'll pass on to Khurana sir. Can you take this question?
Total restructured book is 13,000 crores.
13,000 crores.
Yes.
Okay.
And which is below around 2,800 crores has been reduced from there. And almost 90% is upgraded or closed.
Right, sir. Okay. Thank you. So the last question is on the tax rate. This quarter, the tax rate was slightly elevated. So what has driven that?
Can I take that question, sir?
Yeah. Please.
So actually, from time to time, we have been strengthening our balance sheet. So we had certain tax provisions which we had taken, which we prudentially chose to take this quarter. That has slightly taken up the effective tax rate from around 27%, which used to see earlier, to around 29%, which you see this quarter.
Okay, sure, sir. Thank you so much, sir.
Yeah.
The next question is from Saurabh Kumar. Please unmute yourself and ask the question.
Yeah, sir. First on the restructured book, what is the provisions you're carrying against this? The second is, the specific provisions you did highlight, why it's gone up, but any other reason which is driving this specific provision increase? And third is basically on the credit card subsidiary. Any plans of, when you can consummate a transaction? These are 3 ones. Thank you.
So, Khurana sir, can you take the first 2 questions?
For restructure provisioning, total is around 1,154.
Okay.
And standard assets we have 5,981 for standard assets also we have. For few accounts we have provided specific provision also.
So just to add Khurana sir's statement, on a strategic basis, we wish to strengthen the balance sheet of the PCR is almost at 93 plus at this level. And on the standard assets provisioning also we do have a significant amount, but going forward also we like to strengthen balance sheet more so that any headwinds subsequently can be handled well. And credit card, Jaideepji, can you take this question? Yeah. Sir, just give a minute. Jaideepji, can you take the credit card question? Yeah.
Yeah. So the credit card divestment process that was already initiated by the bank, the process is still continuing. We have gone into the financial due diligence and the legal due diligence portion completion, and the prospective investors who have evinced interest or expressed interest, they are evaluating those reports and the data that has been provided to them, and with the strength of those data points, etc., they will come back with their final bids or offers, which we can consider and take forward. Number one, but again, as we go through the process, it has a sort of a regulatory and a market element also, which we will have to look at and then go forward. So the entire process, which is the usual processes of diligence and the RFP and the binding offers, etc., coupled with the market as well as the regulatory. So that is how we are planning to take it forward.
So if I add to what Jaideepji said, all my decision would be based on the valuation, the market conduciveness, and also subject to regulatory approval. Right.
Got it, sir. Sir, if I can ask, how much is the airline account provided for now? What is your exposure?
Yeah, if you look at the book, last time we said there was almost a 30% exposure which was backed by the ECLGS. Out of the balance 70%, almost we have a collateral backup almost to the extent of 35%, means half of that. And the balance again we had provided last time, and this quarter also we have provided, and that provision is exceeding the balance portion, right? So in terms of accounting provision, everything we are well provided on this point of time. As far as the recoverability is concerned, we are expecting it's a good asset and we recover amount in full based on the primary and also on the collateral.
Got it. Thank you, sir.
The next question is from Kunal Shah. Please unmute yourself and ask the question.
Hello. Yeah, can you hear me?
Yeah, Kunal, go ahead.
Yeah. So firstly, with respect to the deposits, if we look at it between the wholesale and retail, how would have been the growth this quarter? Last time we have shared between the wholesale and retail. Actually, I'm not able to see that. So how much of the term deposits, maybe what has grown almost like 3.6% sequentially, how would be the wholesale and the retail TD? And what would be the rate differential on an incremental basis between the two?
See, you said right that if you look at the system, the growth has been more on the term rather than the CASA. So that's the point we have taken note, and in my initial address also I said that going forward we will be focusing on the CASA. In terms of term deposit, there is not much of difference at this point of time because you have seen a lot of retail scheme. There are a lot of schemes that many of the banks are running. So in terms of a cost matrix, I don't think there is any difference between the cost of raising a wholesale deposit and a retail deposit at this point of time. The only difference would be that the retail deposit of that cost would be slightly for a longer tenure as compared to wholesale deposit of that cost. So suppose going by the rate outlook at this point of time, thinking through some kind of a rate reversal happening maybe in Q3 and Q4, the benefit because we are not carrying a high cost deposit for a longer tenure. And in that way, the bank would be beneficial in terms of repricing all this deposit at a cheaper cost in case the rate reversal happening. But you are right, the cost of, the growth in term deposit is high. And within the term deposit, the growth of, let's say the retail and the rate of wholesale is higher than the retail. But the tenor is much less as compared to the retail. in terms of cost matrix, there is not much difference at this point of time because most of the banks on retail also having large number of schemes, like we do have the Tiranga Plus kind of a scheme. Many other banks have their different scheme.
Okay. But this 3.6, so if we have to look at exact number in terms of the wholesale TD growth on a sequential basis, would that be last quarter also it was quite high? So would that be upwards of 6-7%? How would that be?
So the cost side, you mean to say?
No. Overall growth, quarter on quarter. So what would be the amount of bulk deposits? Like last time we have clearly highlighted. So what would that number be now?
Yeah, I can take this.
Yes. Yeah, please.
Yeah. So that 3.6, Kunal, that you are seeing on the sequential side, the bulk is around 11% and retail term is largely flat.
Okay, got that. So bulk is 11 and retail TD is flat.
Yeah.
Okay. Yeah. Thank you. And in terms of fee income, so again, good traction. What we are focusing, maybe that's one of again the strategic focus area of fees and flow. But in terms of the ROA contribution, how do we see the delta coming through over next 12 to 18 odd months, particularly from the fee income side?
See, that's a very fair point, and as a strategy, actually, the strategy has been done through in the first quarter, right? So a lot of journey has to be traveled on that, but the traction is clearly positive. The growth in fee income this time is 18%, and this is one of the highest in last 5 or 6 quarters I could see, where the growth has been 3.5, 4, and 4.5 kind of a level. So the traction is there, but how much delta it would generate to the ROA, we cannot quantify at this point of time, but definitely it would be ROA accretive. But the overall guidance that we are giving ROA more than one. So in a worst case scenario, let's say going forward, let's say not this year, next year, but couple of years going forward, if there is a bit of NIM squeeze happening also, this would compensate to a substantial scale for a ROA. So although our guidance is 3.3, we'll maintain that. And if you look at the ROA this quarter, it is 1.11, although our guidance is above 1. So it has created some delta, right? So in that way, the delta would continue to accretive, but quantification we are not in a position to do at this point of time.
Sure. Yeah. Okay. Yeah. Thank you.
Yeah, thank you.
The next question is from Jayamundra of ICICI Securities. Please unmute it.
Yeah, hi sir.
Hi, Jay.
Yeah, hi.
Good evening.
Sir, first question is on your floating provisions that we have created of 200 crores this quarter. Is that in preparation to Ind AS or what is the rationale here, and is this going to be a recurring quarterly phenomena?
Before I have a couple of comments, then I'll hand it over to Ian. As far as strengthening balance sheet is concerned, that's a clear glide path we'll be looking forward going forward. ECL is not a immediate necessity, but then it is yet to evolve. And in terms of the impact migration on my book, I'm better prepared because my this PCR is 93 and above. I'm holding substantial standard asset provisioning, which floating provision also one of that. So I'm better prepared to migrate to that scenario. One of the guidance that we were given last time, if there is a ECL impact, we said our credit cost would be maintained below 1. That is a guidance that we were given. So that's a broader theme. Anything further, Ian, you want to supplement?
Yes, sir. So I think what we had called out in the last quarter when we were doing the analyst call is there are several things going in our favor. For example, we have a standard asset provision of almost 7,200 crores. And in terms of the floating provision, I think it is more in terms of our own policy, which requires us to make floating provisions if our profit estimate for the year is above a certain level. So at that stage, we are following our policy. As to whether we will be able to utilize this floating provision towards ECL from a regulatory standpoint, it's still not clear. But once that clarity comes, we'll be able to tell you whether this can be utilized towards ECL. But at this juncture, there's no regulatory prescription saying that floating provision can be used towards ECL, though the regulator lays out various scenarios in which floating provision can be drawn down on. And as to the future outlook in terms of quantum, it is within it will depend on our risk appetite, and if we feel that the credit cost is trending, much below what we estimate, then we may take further full provision, given that our PCR is at all-time high, but we may take some floating provision.
Right. And coming back to yields again, right? So loan yields even adjusted for the recovery or the differential in recovery has increased at 10 basis point. But that rise seems substantially lower if we compare to last 2 quarters, wherein we had witnessed 50, 60 or even 70 basis point rise in the yields. So would it be safe to assume that the 10 basis point rise will flatten further as we go ahead into the coming quarters, or would you say it is too early to say that glide path?
See, you would have the MCLR. Chansab said the MCLR book still has to fully reset. So as of now, that is one of the levers. Another lever would be the change in mix of the retail portfolio. So that would contribute, though it wouldn't greatly contribute, but there would be some 5 basis point we estimate on that regard. I wouldn't say it's totally flattened, but you can't compare it to last year. Last year you had a whole sequential quarter-on-quarter increase in repo. So you can't really compare this year's outlook with last year unless there's a further repo hike. So it's not comparable at all.
And sir, in that context, if you can quantify the MCLR book which got repriced in Q1 and which is likely to reprice in Q2 in rupees crore, that will help us.
I'll speak to you offline and give that to you.
Yeah,
but still a significant portion which is yet to reprice.
Sure. And last question is, sir, on staff cost, right? So I see that we have provided 460 crores wage bipartite in this quarter. Right. But if I look at the slide wherein we give salary and the provisions, I am not able to understand where this 460 crores have been shown. Yeah.
I'll explain you. So there are 2 lines. One is provisions. Provisions is largely a retirement provision, which is your AS15. That is in line with previous quarter. So essentially, it is in the main first line itself where it is factored. Then you will notice a significant increase year on year and quarter on quarter. So if you normalize for the 460 crores of wage revision provision, then the employee cost only increases by around 6-7% year on year.
Right. And sir, in your broader context, when you intend to push more retail versus wholesale, right, 400-500 basis point differential, do you also see a case where OPEX, because when you do more retail, it is a more cost intensive. So how would you look at your OPEX growth for FY24 and beyond? Because when we are more focusing on retail, it sometimes tend to have more cost intensive.
No, that's a very fair question. The retail in terms of growing at 4.5-5% extra doesn't require much of on the HR resources on the underwriting side. The only requirement that we are adding with regard to more of relationship management side, more tie-ups. So one thing that we said that we need to have more project approval for a housing loan kind of stuff. The digital penetration in terms of retail is significantly going up. So now we have a couple of products which are entirely end-to-end digital on the retail side. We again intend to make to a large subject to a particular ticket size more of digital. In case the attributes, everything can be digitally processed and the sanction can be given. So one way when there would be additional requirement of OPEX, at the same time, as I said also earlier, we are also carrying out a huge process automation journey. So it would be balancing out to a very large extent. But the only thing that retail we try to get is a margin more accretive as compared to corporate, right? So any bit of extra spend on the OPEX would be well compensated by a higher margin on the retail. So that fairly would maintain my NIM and also the ROA going forward.
Sure, sir. Thank you and all the best.
Thank you.
The next question is from Rakesh Kumar of BNK. Please unmute yourself and ask the question.
Yeah, hi. Thank you, sir. So, sir, firstly, related to this stressed loan number which is there in the notes of accounts from 11 to 14. Total number was coming to around 81 billion, around 8,100 crore, and provision, if I see notes of accounts in 10, we have given provision of around 1100 crore that we have made, and there is another provision of 296 crore that is also there that we have made in the notes of accounts number 12 or 13. So here on the stressed asset number, we have a provision, a standard stressed asset number, provision is around 17%. So apart from that, the restructured number that you have, which you have mentioned just now, on that, how much is the provision, sir?
So can I just take one item?
Yeah, please, yeah.
So I'll talk about note of accounts number 10. So largely, we spoke about couple of large accounts which we have provision for. One is a PAR account, one is the whole Go First account. So we have 639 crores of Go First, and one PAR account which I will not name since it's not in the public domain. We have around 255. Then we've taken one hospitality account, 87 crores. So largely, broadly, that gives you the texture. These are not restructured accounts. These are accounts where we felt there could be imminent stress, including the Go First. So that largely explains you that 1100. So this is nothing to do what we talked about restructured.
Got it. And so total stress, standard stress number is around 8,100 crore. If we take the summation from 11 to 14 details. If we take the summation of numbers, the stressed asset number from notes of accounts number 11 to 14, so total stress number is 8,000 crore, 8,100 crore, correct?
No, total SMA 1 and 2, that is around 15,000 crores. And our restructure book is 13,000 crores. But the entire restructure book is not under stress. Most of the accounts are getting paid earlier. Also, if you look at that, only 5,000 crores which have already been slipped to NPA, and now stress is very less in that. So this stress book includes restructure as well as the SMA 1 and 2, that is 2.9%, 2.95% of total book.
Okay, the second question was pertaining to the power sector exposure in the presentation that we have given. So there is a reduction, we have seen constant reduction in that number, the outstanding exposure in the power sector. So is there any guideline coming from the regulator that, to reduce exposure in a specific state, SCBs, or is there anything pertaining to that, or what is the reason for the same?
See, as far as the exposure to power sector, will continue to be long on power sector. So absolutely there is no kind of any pullback on that. And secondly, there is no instruction from anywhere with regard to any particular state or so. So thirdly, normally portfolio churn happens depending upon the timing of all these loans. So Tyagi, anything further you want to add on this?
No, so in fact, there is no specific assets we can talk about right now. The only thing is that, as MD said, that there can be some portfolio churning, some redemptions or lack of drawdowns on the working capital side. But other than that, it's portfolio is behaving normally.
Got it. This is pertaining to Bank of India management said that they have got some guideline from the regulator saying that they have to reduce exposure in some of the states, and there is some category also for where the RBI has put different states in different category. So have we also received any such guideline notification from the RBI?
No, we have not.
We said that that would be linked to the portfolio concentration. So if you look at our concentration, it's fairly balanced. So absolutely nothing like that.
Okay. Thank you. Thanks for the clarification, sir. Thanks a lot.
Yeah.
The next question is from Ashok Ajmera. Please unmute yourself and ask the question.
Thank you for giving me this opportunity, and compliments to you, Chand Sahab, and the entire team, especially to improve the asset quality of the bank. Like if you take the gross NPA come down substantially to 3.51, net NPA 0.78, PCR 93.23, and you also have a buffer of the provision as per note number 10 of 1,107 crores, though you are putting it into some specific accounts, but actually it is beyond the IRAC norm, which is strengthening the overall balance sheet of the bank. Having said that, sir, I have got a couple of questions and some observations. Sir, on the recovery front, especially in this quarter, if you compare with the last quarter, our performance is little dismal because our overall recovery in this quarter has come down to 986 crore as against 1,795 crore in the March quarter, as well as the recovery in the return of account is also has come down to 663 crore against 1,447 crores. So on the recovery front, though we got the figures of the restructured account and all that, but what are our efforts and why did this quarter did not perform so very well on the recovery side? Maybe some breakup of the towards like any change in the OTS scheme or any change in the So some color on that, sir. And going forward, where do we stand the recoveries? Where do we see the recoveries?
So thank you, Ajmera Sahab. Actually, I was expecting you be the first in asking question, but then
sir, I was there right from the beginning. My hand was raised first, but I don't know. But anyway.
So next time we will catch up physically. So giving a color on the aspect, thank you very much for complimenting the entire management team on the performance. And secondly, before I hand over to Khurana Sahab, just let me give you some color. Typically, if you look at the June quarter vis-a-vis the quarter four of last year, previous year, they are typically not comparable because this is the beginning of the slack season and then all those things do happen. And these are time when a lot of transfer happens, a lot of processes happens, and it impacts the, the normal momentum on the recovery kind of a drive. But one guidance that we are clearly giving that when looking at the fresh slippage vis-a-vis the cash recovery plus liquidation, the net would be very minimal going forward for the full year. But specific point, Khurana Sahab, if you can answer the question.
I would like to add what MD Sir told. Actually, the last quarter, there were some very big accounts which were settled. 1,700 crores came from some big accounts. And then it also depends upon the addition which is happening in the previous quarters. So quarter by quarter, these slippages have been reducing. If we look at the Q1 of last year, in the March quarter, the slippage was 4,300 crores, which has been reduced to 2,200 crores in last quarter, and now to 2,452 in this quarter. So because this slippage is also reducing, the recovery also is reducing. In addition to that, what MD Sahab told, because of the season and the staff, but otherwise our efforts are on. We are, whatever targets we have already fixed for the recovery, we will surely achieve them. And so many other OTS scheme and many other processes are going on for recovery. Every step, whatever is possible to recover, we have been taking very efficiently.
What is the target, sir, for FY24 for the overall recoveries?
12,000 crores.
12,000 crores.
Yes,
so out of that, 986 crore has come only in this quarter. So remaining 11,000 crore in the next three.
No. It includes upgradation as well as the recovery in return of accounts. That comes to more than around 2,600 as of now.
Sir, my one small question on just a point which I saw in the note number 18. There is some penalty by RBI of 57 lakhs. So is it a routine kind of a penalty or some specific incident has taken place or some violation has taken place, sir?
Yeah, Ian, can you take this point or otherwise offline we can clarify on the matter?
I'll clarify offline, sir. I'll get back to it, sir.
Sir, my other point of information is that we have given that the entire fraud account in this quarter have been provided for. But the number has not been given, that how much was that fraud account and how much, so that we come to know that exactly in this quarter how much provision on account of the fraud was made, sir.
So in terms of, there are two things. One is the opening balance of fraud at the end of March, that was about 13 crores. Second is incremental fraud during the quarter was around 16 crores. So not a very significant number if you think more together.
Sir, coming in last answer in the aviation account, of course you have given some color on that how much has been provided for in the collateral. But in absolute terms, I understand that it is around 1400 to 1500 crore. Our total, because you and Central Bank are the two main banks, and I think Central Bank is around 2000 crore and yours is about 1500 crores. So in absolute terms, if we understand, then according to you, 30% of the provision was made in the last year itself on this account. Then some provision is under note number 10 and that 1107 crore which is extra, and some provision which has gone into the provision of this I think it's the SMA 2 into the regular provision also. So overall provision out of this 1500 crores is how much so far stands in our book.
So can I take that?
Yeah, please.
So there's a non-ECLGS component of 1200, out of which we have made a provision of 639.
How much?
639. 509 in the March quarter and 130 crores this quarter.
Then you said that you have got a substantial collateral of almost 60-70% of the value. So is it the consortium collateral or there is some standalone separate collateral also to you?
It's consortium collateral.
It's all consortium collateral only, which may fetch almost about 50% of the total.
50% of the balance of ECLGS
balance.
Exposure.
All right, sir. The point well taken. Sir, now going forward, like we have grown our credit book well in this quarter.
Just I add also on this point, although accounting provision we have made, but as far as the recoverability is concerned, we expect full recovery out of this account. That is what our management view on that.
And you see the airline flying away again. Now, I will.
No, I'm not commenting. I'm only commenting as far as primary collateral ECLGS. We expect a full recovery, but accounting we have provided what is required as a
we are also concerned with that only, that whatever recovery you are expecting. Sir, coming to this credit side, we have grown our book very well in this quarter, 2.1 or 2.2 for the global, as compared to some of the other bank, which couldn't carry the same as compared to the last quarter. So now going forward, your guidance is around 14-15% overall of the credit book. Looking at Bank of Baroda and the way you all are, like major thrust you are putting on retail as well as you are also opened up the corporate, you have started the relationship managers, the full-fledged concept and this thing. Don't you think that our target though is good, it's a little more than the industry norm, but can be still increased to say 16-17% of the range?
I said one of the conversation that we have bit of trend of overperforming vis-a-vis guidance, so you take it in that way.
All right, sir. Thank you very much for giving me this opportunity.
Thank you. It's a pleasure interacting.
Just one small end of this thing. We have this pension, revision in the pension that amounting to almost about, I think it was about 880 crore something balance of the last year. We have provided this quarter about 72 crore. If I'm not wrong. So the 799 crore has been carried forward to be amortized, which an auditor has mentioned that had this been provided, our profit would have been lower net of tax of 589 crore. So was there any need of mentioning that when it is allowed as a dispensation by RBI and you are permitted to do so? Was there any talk with the auditor on that? Because I don't see in some of the other banks this point coming that had this been 100% provided, the profit would have been lower by 589 crores. So this is number one. And going forward, if the ACL guidance comes, then I think all this kind of, the amortized or to be amortized or unprovided thing also will have to be taken into consideration.
So can I take that question?
Yeah, please.
So, Ajmeraji, there are two things. One is it is regulatorily permitted, but this is a special dispensation given by RBI. but this is a carve out from the accounting standards. So as per the audit requirements, since it is a carve out from accounting standard, we need to mention it and quoting the regulatory reference. That is the reason why it is mentioned. Secondly, this is something that we are evaluating on a regular basis, and well before the India's guidelines come in, this will probably no longer be there.
Thank you, sir. We are taking a question from MB Mahesh of Kotak. The overall cost of deposits that increased QOQ was 25 bps QOQ, but the July interest rate disclosure does not see an increase in MCLR. The June disclosure saw an increase only in one bucket. Why is there a poor transmission of cost of deposits into MCLR? Thank you.
See, as far as MCLR computation is there, that depends upon a lot of other metrics. So it's not typically linked. It depends on the cost of deposit the bank has, right? So that is one point. The second aspect is some of the upside that we see on the loan MCLR book is a resetting of MCLR. Even the MCLR was increased earlier, but the reset has not happened. So that's the upside available quarter to quarter. And this typically, I believe, is the answer to it. Anything Tyagiji or Ian can take further, supplement further?
Yes, so the MCLR formula as defined by RBI is different. It is not typically taking it as we typically see it from a commercial sense. So I think what Chansab said is correct. And it is a reset of the 1 year book that we are seeing as a guidance that we are giving, that there is an upside still left.
Yeah, nothing to add, sir. Thank you.
That's fine.
We have another question in the Q&A box from Krishna Kumar Srinivasan. What is the mix of growth plans for FY24 and 25 in terms of corporate and retail? What's the pipeline looking like in terms of loan approvals and sanctions? Thank you.
Sure, I'll first just answer and give it to Tyagisa on this. See, we set a broader guidelines with regard to the portfolio mix of 35-65 in a couple of years from now. If you look at the current corporate book is almost at 42%. So while I target, let's say 3-year target of 35, so the trend would be you can prorata, you can that way reduce it down. But anything Tyagisa further you want to add on this?
So in terms of the pipeline in corporate, there are good traction from the infra, renewable, and some of the industrial sectors where working capital demand is now coming up. So whatever our goal projections are there in corporate, we are pretty confident that we will be able to make. And as MD said, in terms of the retail growth, we are consistently growing our retail book to rebalance our mix of corporate and retail, and we are confident to maintain the guidance which we gave at the beginning of the year.
Yeah.
Thank you, everyone. I'm sorry, but we are running out of time, so this is the last question. I'll now invite Ian to please give the vote of thanks.
Thank you, everyone, for joining us. And as usual, these questions have all given us food for thought, and we will, be building some of them into the way we interact with you going forward. Look forward to interacting with you some on a one-on-one basis. I think many of you have interacted with us on a one-on-one basis. Looking forward to those interactions from Monday onwards. Thank you very much for joining us on a Saturday. I know it's already 5:30 on a Saturday. Thank you for being engaged with us. Take care.
Thank you all. Thank you very much. Thanks.
Thank you, everyone.